Right now, something shocking is happening in the gold and silver markets. This is not a slow drop. This is not a normal pullback. This is not the market taking a break. This is a straight down fall, and it is happening live while people are watching their screens. As this is being recorded, gold has fallen through levels that many believed would never break. Silver is dropping even faster. Every time prices refresh, they are lower than before. 1 minute it looks bad, the next minute it looks worse. There is no pause, there is no bounce, there is no relief. What we are seeing is not a normal market move anymore. This is a full-scale crash in motion. Just a few days ago, many believed the worst was already over. On Friday, silver dropped by an amount people had not seen in decades. Gold also took a massive hit. It was one of the worst single days in modern market history. After that, most traders thought, that's it, the selling is done, the weak hands are gone. They were wrong. Instead of calming down, the selling picked up speed. The market did not slow, it accelerated. What is happening now is forced selling. This means traders are not choosing to sell. They are being pushed out. Accounts are being closed automatically. Positions are being wiped out one by one. Money is disappearing faster than people can react. This is what panic looks like when it spreads through a financial system. And the scariest part? Many people still don't understand why this is happening. They think it's just fear. They think it's bad news. They think it's a normal market crash. It is not. Behind the scenes, something much more serious is unfolding. When markets fall like this, the real damage is not always the price itself. The real danger is when people lose control of their positions, when systems force them to sell at the worst possible moment, when exits are closed and there is no escape. That is exactly what is happening right now. Some traders believed they could wait it out over the weekend. They planned to sell when markets opened again, but when they tried, they found something terrifying. They couldn't sell at all. Orders were rejected. Systems wouldn't accept trades. Selling was blocked. People were trapped inside, losing positions with no way out. This is not something most investors ever expect to experience. And this is why moments like this matter so much. Not because of fear, but because of truth. Because crashes like this reveal how the system really works when it is under pressure. What you are watching is not random, it is not accidental, and it is not over yet. In the next phase, we'll break down what triggered this collapse, why so many traders were forced out at once, and how a single hidden mechanism turned a bad drop into a violent crash. To understand why this crash became so violent, you have to look past headlines and price charts. The real cause was not fear, not bad news, and not investors suddenly changing their minds. The real trigger was something most people never pay attention to: margin rules. Most traders in gold and silver do not buy the metal outright. They trade futures contracts. This allows them to control a large amount of metal with a much smaller amount of money up front. For example, instead of paying for $100,000 worth of silver, a trader might only need to put down $10,000. That money is called margin. It's like a security deposit. As long as prices stay stable, this system works fine. But there is a hidden danger. The exchange can change the rules at any time. When an exchange raises margin requirements, it means traders suddenly need more cash immediately. Not tomorrow, not next week, right now. If a trader doesn't have that extra cash ready, the system does not wait. It closes the position automatically and sells it at whatever price exists in that moment, even if the price is terrible. Now imagine this happening to thousands of traders at the same time. That is exactly what happened here. Over a short period of time, the exchange raised margin requirements again and again. Not once, not twice, but repeatedly. Each increase drained more cash from traders who were already under stress. At first, some traders survived. They had savings, they had extra funds. They thought they could ride it out, but the hikes kept coming. Every time traders thought the pressure was easing, another increase hit. Each one forced more selling. Each one pushed prices lower, and lower prices triggered even more forced exits. This creates a chain reaction. Selling causes prices to fall. Falling prices trigger margin calls. Margin calls force selling. Forced selling pushes prices down again. This loop feeds on itself. At a certain point, it no longer matters if traders believe in silver or gold long term. Belief does not stop liquidation. Cash does. And most traders eventually run out of it. This is why the crash felt sudden and unstoppable. It wasn't one bad decision. It wasn't one big seller. It was a system pushing people out all at once. And here's what makes this even more extreme. The speed and number of these margin increases were unlike anything seen before. In normal years, margin changes happen slowly and rarely. This time, they were stacked tightly together. That kind of pressure doesn't just shake out weak traders. It wipes out almost everyone who is overexposed. This is why prices didn't stabilize. This is why there was no bounce. The selling was not voluntary. And when selling is forced, the market does not care about value, history, or logic. It only cares about closing positions as fast as possible. But this still raises a bigger question. Why apply this much pressure now? Why tighten the system so aggressively? And why did it happen at the same time in multiple parts of the world? That's where things get even more interesting. If this crash were only happening in one country, it would be easier to explain. You could blame local traders, a single exchange, or one bad policy decision. But that's not what we're seeing. What makes this situation so unsettling is that the same kind of pressure showed up in different parts of the world at nearly the same time. That does not usually happen by accident. Financial systems in different countries don't normally move in perfect sync. They have different rules, different regulators, and different priorities. They often disagree on almost everything. And yet, suddenly, multiple major exchanges tighten margin rules almost together. That should make anyone stop and think. When systems that rarely agree start acting the same way, it usually means they are reacting to the same risk. So what risk could be big enough to cause this? To answer that, you need to understand how the silver market really works behind the scenes. Most silver trading today does not involve actual metal moving from one place to another. It is paper trading, contracts, promises, claims on silver that may never be delivered. This system works fine as long as most traders are happy to settle in cash. They close their positions, take profits or losses, and move on. But the system breaks down when too many people want the real thing. There is far more silver promised on paper than there is silver sitting in vaults. This is not a secret. It's how the system has been built for years. Under normal conditions, it's not a problem. But conditions are no longer normal. Recently, large amounts of physical silver have been leaving storage facilities, not being traded, not being rolled forward, actually being removed and taken away. This kind of movement doesn't come from small investors. It requires logistics, security, transportation, and storage. It comes from large players with long-term needs. And once physical metal starts leaving the system, pressure builds fast. Now think about what happens if many contract holders suddenly ask for delivery at the same time. The math stops working. If there isn't enough metal to meet those promises, the entire structure gets exposed. Confidence disappears. And when confidence goes, markets can break. This is why exchanges care so much about delivery periods. These are moments when paper claims are tested against physical reality. If too many people demand metal instead of cash, it creates a problem no margin rule can solve. So what do exchanges do when they fear this outcome? They try to reduce the number of people who can demand delivery. They raise costs. They tighten rules. They force weaker positions out early. If traders are gone before delivery dates arrive, the risk goes away. This helps explain why pressure is being applied now and why it appears coordinated. It's not about price. It's about control. But here's the twist. While paper prices are collapsing, physical silver in other parts of the world is not following the same path. And that disconnect tells a very powerful story. In a healthy market, prices tell the truth. If demand falls, prices fall. If supply dries up, prices rise. Paper prices and real-world prices move together. That's how it's supposed to work. But right now, that connection is broken. While paper silver prices are collapsing on screens in the West, the price of real physical silver in other parts of the world is staying much higher. In some places, buyers are paying far more than the number you see on financial news channels. This is not a small difference. It is not normal noise. It is a massive gap. And gaps like this don't exist in efficient markets. Think about it this way. If silver were truly worth the low paper price, no serious buyer would pay much more for it elsewhere. Big buyers don't like overpaying. They are disciplined. They are careful. They have options. Yet they are still paying higher prices. That tells you something important. It suggests that the paper price is no longer reflecting reality. Instead, it is being pushed down by forced selling, rules changes, and automated liquidations. Physical buyers don't play that game. They buy metal because they need it for manufacturing, for reserves, for long-term use. They don't care about daily price swings on a screen. They care about supply, and supply is tight. And when physical prices stay firm while paper prices crash, it's a warning sign. It means the market is split in two. A paper market driven by leverage and forced exits. A physical market driven by real demand and real shortages. This split cannot last forever. Either physical prices will eventually fall to match paper, or paper prices will snap back toward physical reality. History shows that when shortages exist, physical usually wins. Another sign of stress is how hard it has become to borrow real metal. When institutions need silver and cannot find it easily, borrowing costs rise. This only happens when supply is strained. No one pays high fees to borrow something they expect to get cheaper soon. They pay those fees because they need it now. At the same time, storage vaults are being drained. Large amounts of metal are leaving the system. This isn't speculation, it's movement. When metal leaves vaults during a price crash, it sends a clear message. Someone believes the paper price is wrong. And while this is happening, regular traders are being shaken out. Many are selling in fear or being forced out entirely. They are watching prices fall and assuming something must be broken in the fundamentals. But the fundamentals haven't changed. Demand is still strong. Supply is still limited. Industrial use keeps growing. Only one thing has changed. the paper price. This is why moments like this are so dangerous and so important at the same time. They confuse people. They make strong assets look weak. They reward panic and punish patience. When markets crash this hard, most people assume everyone is losing. That's not true. In every major collapse, money doesn't disappear. It moves. It shifts from one group to another. And understanding who benefits tells you a lot about what's really happening. During this crash, many regular traders were wiped out. Some lost years of savings in days. Others couldn't even exit their positions because systems froze or trades were blocked. But while that was happening, some players were on the other side of those trades. When prices fall sharply, anyone betting on lower prices profits. The faster and deeper the fall, the bigger the gain. Large financial institutions often operate differently than individuals. They have deeper pockets, better access to information, and more flexibility. They can survive margin hikes that destroy smaller traders. They can also influence market structure simply by their size. This doesn't mean laws were broken. It means the system is built in a way that favors scale. Another advantage large players have is timing. They can position themselves ahead of major rule changes. They can reduce risk before volatility hits. They can hedge losses in ways most people cannot. So when forced selling begins, they are not scrambling. They are ready. This helps explain why crashes like this feel unfair. The rules technically apply to everyone, but the impact is very different depending on who you are. There's also something else that stands out. Unusual trading activity often appears before major moves. Large bets placed just ahead of collapses are rarely luck. They suggest preparation. Again, this doesn't require illegal behavior. It only requires better insight into how markets respond under stress. While traders were focused on charts and headlines, others were watching rule changes, delivery risks, and physical supply. And while panic selling crushed prices, those same players were able to either profit from the drop or quietly prepare for what comes next. This is why crashes feel brutal. They don't give people time to think. They push decisions into moments of fear. But the biggest damage wasn't just the losses, it was the loss of access. Some funds were frozen, some trading platforms stopped working, some investors couldn't even see their account balances. When markets function properly, you can always trade. When they don't, it's a sign of stress. A system that blocks exits while prices fall is not protecting investors. It's protecting itself. And this leads to an uncomfortable question. If the system locks up during stress, what does that say about its stability? Now let's step away from screens, charts, and panic for a moment and look at the real world. Because when you do, this crash makes almost no sense. Silver is not some outdated metal sitting in warehouses with no purpose. It is used every single day, all over the world. Modern life depends on it more than most people realize. Solar panels need silver, electric vehicles need silver. Phones, computers, and data centers need silver. Medical tools and advanced electronics rely on it. This demand is not shrinking, it's growing. At the same time, silver production is not rising in any meaningful way. Mining takes years to expand. New discoveries are rare, costs are rising, supply is tight. For years now, the world has been using more silver than it produces. That means inventories slowly get drained. Once that metal is gone, it doesn't come back. This has been happening quietly in the background while prices were rising. And it is still happening now, even during the crash. Nothing about that has changed. On top of this, major producers have started putting limits on exports. When large refining hubs restrict how much silver can leave their borders, global supply tightens even more. That kind of move doesn't point to abundance, it points to concern. And yet, despite all of this, rising demand, limited supply, shrinking inventories, the paper price is collapsing. That disconnect is the key. If this were a real demand-driven crash, factories would be slowing down, orders would be canceled, physical buyers would disappear, but that's not what's happening. Instead, physical premiums are rising in many places. Dealers are struggling to source metal, buyers are still lining up. The crash exists mainly in leveraged paper markets, where rules, margin changes, and forced selling dominate price action. This is why so many experienced observers are uneasy. The fundamentals say one thing, the paper price says another. And history shows that when these two drift far apart, something eventually gives. Usually it's the paper side. But before that happens, damage is done. Businesses get hurt. Funds freeze withdrawals. Traders lose everything, even when their long-term view was correct. This is one of the hardest lessons in markets. Being right is not enough. You have to survive long enough for reality to show up. That's why crashes like this are so dangerous. They punish leverage and patience and weak risk control, even when the underlying story remains strong. At this point, many people are staring at prices and asking one question. Where's the bottom? That's a natural question, but it's also the wrong one. In crashes like this, price levels stop being reliable. Support lines break. Safe zones fail. Numbers that should matter suddenly don't. Instead of guessing where prices might land, the smarter move is to watch signals, signs that tell you whether the stress is easing or getting worse. One of the most important signals is the gap between paper prices and physical prices. When that gap stays wide, it means the paper market is losing credibility. It means real buyers are not accepting the screen price as truth. If that gap grows even wider, it's a warning that the paper system is under extreme strain. If it narrows because paper prices rise toward physical value, that tells you the pressure is shifting. Another signal is what's happening in storage vaults. When large amounts of metal continue leaving during a crash, it means big players are not scared. They are acting with intention. They are planning beyond today's price. Borrowing costs for physical metal are another clue. When those costs spike, it means supply is tight and demand is urgent. This is not behavior you see when prices are about to collapse long term. You also have to watch market function itself. Healthy markets don't freeze. They don't block exits. They don't lock people out of accounts. When trading halts spread and systems struggle, it means stress is moving from prices into infrastructure. That's when risks become systemic. All of these signals tell a story, and that story is very different from what the falling paper price alone suggests. Here's the hardest truth of all. Crashes don't destroy wealth, they transfer it. Money moves from people who are overexposed, underprepared, or forced out to those who are patient, liquid, and able to act when others can't. That transfer is painful to watch. It's emotional. It feels unfair. But it happens in every major financial event. The difference between those who survive and those who don't usually comes down to one thing: risk management. Not prediction, not intelligence, not conviction, survival. Plenty of people are right about long-term trends and still lose everything because they used too much leverage, trusted systems too much, or assumed exits would always be there. The winners in moments like this are not the loudest voices or the boldest predictions. They are the ones who stayed flexible, stayed calm, and sized their exposure so they could live through uncertainty. This moment will pass. The gap between paper and physical will close. Reality will reassert itself. The only open question is who is still standing when it does. That's why understanding what's happening now matters so much, not to scare you, but to prepare you, to help you see beyond the flashing prices and understand the forces underneath. This isn't about telling you what to do with your money. That choice is always yours. It's about seeing clearly, because when clarity returns to markets, opportunity follows. And those who made it through the chaos are the ones positioned to benefit.